On March 22, 2026, 195 nations reached the final deadline for the Integrated Biometric Payment Standards. This leather wallet, abandoned on a city sidewalk, has been rendered functionally obsolete. For decades, consumers accepted a high level of physical friction as a standard part of life. We dealt with the panic of misplacing a wallet, the stress of a frozen account at the grocery checkout, and a 10-year rise in identity theft. Traditional plastic cards relied on embedded chips that were increasingly slow to process. For global businesses, these seconds of latency added up to massive inefficiencies in high-volume environments. To remove these bottlenecks, the Big Six financial institutions initiated a $4.2 trillion infrastructure overhaul. The goal was to replace physical tokens with a system of contactless, identity-based commerce. This resulted in the ISO 2026 standard. It merges iris scanning and palm vein verification into a singular digital protocol called the Unified ID. The transition was framed as a mandatory update to the global economic engine. By removing cards, banks promised zero-latency transactions and the end of retail queues. The global rollout was completed in just 81 days. By February 2026, 85% of major retail hubs had replaced their registers with terminals that recognize unique subcutaneous vein patterns. Unifying disparate banking laws into a single biometric code caused cross-border transaction fees to drop by 15%. This change immediately improved margins for small export businesses moving goods through international ports. While trade became more efficient, removing physical friction meant the sudden extinction of the industries required to manage paper and plastic money. Billions of credit cards became garbage overnight. Industrial shredders at recycling facilities were used to reduce these symbols of wealth into bins of plastic shards. As the demand for physical cash evaporated, traditional ATM manufacturers went bankrupt. Thousands of machines were sold for scrap metal and dismantled in junkyards. In the IT sector, the shift to centralized biometric servers replaced thousands of individual card readers. This allowed companies to cut their hardware maintenance staff, leading to mass layoffs of junior technicians. The drive for absolute convenience resulted in the rapid removal of legacy physical labor and hardware from the global economy. Transaction speeds increased by 40% under the new standard. As spending became faster, it also became more abstract, decoupled from the tactile experience of physically handing over currency. This speed correlates directly with a spike in average household debt. The fragility of this centralized system was exposed when a temporary data glitch locked 12 million citizens out of their biometric profiles. Because there were no manual overrides and no physical cash to fall back on, those affected were unable to pay for food or fuel. The glitch turned a technical error into a crisis of basic survival. This failure led to widespread biometric anxiety, sparking large-scale protests from citizens demanding the right to transact through analog methods. Street-level muggings dropped by 90% after the mandate, but the safety came at a cost. Maintaining the system requires a dense network of security cameras and sensors monitoring all public commerce. Physical danger was replaced by digital vulnerability. As muggings disappeared, individual cybersecurity insurance premiums skyrocketed to cover the risk of centralized identity theft. In this economy, your biological data is the only valid way to authorize a transaction. Your iris and palm vein patterns are the permanent identifiers used to authenticate your place in the global financial system. As we move past 2026, the question is no longer whether the technology is efficient. The question is whether absolute convenience was worth giving up our final layer of financial anonymity.